A recent study by Ernst Young made the startling claim that investors who contribute 30% of their retirement savings to cash value life insurance, what I refer to in my best-selling book, The Power of Zero, as the LIRP, will have their retirement savings last longer than those who put 100% of their retirement savings into investments alone. How could this be? It seems to fly in the face of every financial guru who's ever addressed the subject of cash value life insurance. For example, Dave Ramsey says that if you have a permanent life insurance policy, you should surrender it immediately, regardless of how much you would incur in surrender charges. He also says that the only reason anyone ever gets cash value life insurance is because they're dupes and they just haven't researched it enough. And in the moment they do research it, they'll abandon any plans they ever had to enter into the arrangement. Susie Orrin says that if any financial advisor ever talks to you about cash value life insurance, you are to, quote, never work with that person again, close quote. She further declares that, quote, anyone who is trying to sell you life insurance as an investment is not acting in your best interest, close quote. So how could this Ernst Young study be so diametrically opposed to what these venerated financial gurus routinely tell their faithful acolytes? Well, to understand the reasoning behind their conclusions, you have to understand the basics of what is commonly referred to as a volatility buffer. I described it as the Volatility Shield in my best-selling book of the same title. Here's how it works. It's commonly understood that if you take a strict investment-only approach to retirement, that you build up a huge pile of money by day one of retirement and then limit yourself to a modest distribution rate each and every year, adjusted for inflation. Many experts agree that distribution rate is 4%. Some have revised that number downward to only 2 or 3%. But let's use 4% for today's example. That means that if you were to accumulate $1 million by day one of retirement, the most you could distribute is $40,000 per year, adjusted for inflation. So if experts predict you can anticipate a rate of growth much closer to 8% over the course of your lifetime, why can you only take out 4% per year? Because if you take out higher than 4% per year, you dramatically increase the likelihood of sending your retirement portfolio into a death spiral from which it never recovers. By constraining yourself to a modest 4% distribution rate in all years, even years following a down year in the market, your retirement savings have a much higher likelihood of lasting through life expectancy. In fact, it can be as high as 86%. Not 100%, but much higher than the success rate of the 5 to 8% distribution rates. As it turns out, it's most important for you to obey the 4% rule in the first 10 years of retirement. This is because you can typically expect 2 to 3 down years in the market during those first 10 years. And if you take 5 to 8% distributions in the years following those 2 to 3 down years in the market, your portfolio survival percentage falls like a rock. Once you hit years 11 plus, it's not quite as critical, but those first 10 years are the real danger zone. So the question becomes, how does contributing 30% of your retirement savings to a cash value life insurance policy during your accumulation years help solve this quandary? Well, what if you could accumulate several years worth of living expenses in your LIRP by day one of retirement? By relying on tax-free loans from your policy, you could avoid having to take money out of your stock market portfolio during those 2 to 3 down years in the first 10 years of retirement. You could then allow your portfolio to recover before resuming distributions in the ensuing years. By letting your portfolio recover before taking further distributions, you'll find that your sustainable withdrawal rates in retirement skyrocket. How high? We'll get into that in a minute, but before we do, let's talk about the attributes the LIRP possesses that make it the ideal volatility buffer. First, LIRPs grow safely and productively. You can't combat market risk with an account that's exposed to market risk. Next, LIRPs, specifically in the form of Index Universal Life, have a historical track record of between 5 and 7% net of fees over time. It's much easier to accumulate the amount of capital required to shield yourself from volatility if that money is growing productively between now and when you retire. Next, LIRPs are tax-free. This is paramount because if you don't have to pay taxes during the accumulation and distribution phase, your money will grow more efficiently and you won't have to save as much money along the way. Also, if you can take distributions from your LIRP tax-free, you aren't exposing yourself to tax rate risk, and those distributions don't count as provisional income. That means they won't count against the thresholds which cause Social Security taxation. And so long as the LIRP is in place and fully funded by day one of retirement, you'll be in a position to pay for lifestyle expenses in the years following a down year in your stock market portfolio. In summary, Your LIRP functions as the ideal volatility buffer because it grows safely and productively in a tax-free way, and so long as it's fully funded by day one of retirement, it can serve as the ideal buffer against market volatility. All this said, how much do you need to contribute to your LIRP each year in order to pay for 3 to 4 years of living expenses in the first 10 years of retirement? Well, according to the Ernst Young study, it's about 30% of your retirement savings. And if you contribute 30% of your retirement savings, you'll find that your sustainable distribution rate in retirement skyrockets. In fact, it can go as high as 8% per year. And if you can take 8% per year from your retirement balance in retirement, your retirement balances, mathematically speaking, are going to last longer. This is the case even if those balances aren't as high because you diverted 30% of your contributions to the LIRP along the way. In summary, the Ernst Young study was groundbreaking because it made a mathematical and statistical case that cash value life insurance, what I refer to as the LIRP, can help extend the life of all your other investments by, in some cases, doubling your sustainable withdrawal rate in retirement. And at the end of the day, the most viable retirement strategy is the one that gives you the highest likelihood that your retirement savings will last through life expectancy. Folks, in the next 10 years, I'm looking to put 100,000 Americans on the road to the 0% tax bracket. If you'd like some help getting on the road to a tax-free retirement, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head on over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comments section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is Dave McKnight. I look forward to seeing you on the next video.